Sustainable investment, as defined by Sustainable Capital, is the integration of environmental, social and governance factors into the investment management practices, with the conviction that they'll have a material effect on long-term financial performance, and by default, of course, shareholder value. So joining us from Cape Town now to explain how this works in practice is Greg Barker, co-manager of the Africa Sustainability Fund. Welcome, Greg, and perhaps start off by saying what the broad philosophy is behind this Sustainability Fund.
Well, the investment philosophy is really that there are material environmental, social and governance factors, whether they be in a mining company, a bank, a hotel or a utility company, which impact directly on the financial performance of companies and ultimately their shareholder value. But what's interesting in Africa, in an environment of imperfect information, is that those material factors are often mispriced in financial markets, and particularly in the listed equity markets, which is where we specialize. And so in addition to the normal investment valuation and financial analysis, we tend to spend a lot of time looking at those longer term risk and opportunity factors and actually building that into our portfolio construction process. So the Africa Sustainability Fund, which has now just reached a 3-year track record, it really essentially upweights the highest quality companies and countries in Africa and vice versa in quite a structured and disciplined way in a 40 stock diversified portfolio where the objective is really to give investors exposure to the growth of listed equities in Africa at a much lower level of risk than the market cap benchmark.
Greg, you use this, and you just touched on it now, this process where you identify the sustainability rating of country and companies. And I just wanted you to explain how that ties in with your bottom-up value approach, if you could call it, on the financial side of things.
Sure. In the Africa Sustainability Fund, we have a fundamental weighting as the starting point after cutting the stocks down in terms of liquidity. So if you look at the Africa listed equity universe, you've basically got, say, 1,300 listed equities that are Africa dominant, ex-South Africa. We cut that down immediately to 250 stocks just by liquidity. So we're typically dealing with more blue chip companies with strong financial track records, established business models and financials, and there's a value bias implicit in that construction process. Then we've got a sustainability overlay where effectively we actually measure the operating environment of the companies in terms of country sustainability. And when I say that, I mean it in quite a holistic way, where we include political stability, rule of law, control of corruption, environmental stability, government effectiveness, infrastructure quality. In other words, anything that differentiates a country in terms of the ability of a company to do business there. And we actually measure that quantitatively. So for example, for infrastructure, you might look at telecom, road, rail. Under that, a metric might be, how many days does it take you to get a 40-foot container from a port to the final destination in that country? And we're measuring that for all the African countries across the board. And then on the company side, we do the bottom-up research on the ground, doing detailed due diligence and research on the companies through management interviews, on-site visits. And through that process, essentially what happens within the portfolio construction is that we materially upweighting the higher quality companies and countries and downweighting or excluding those that through our process we rate as low quality. And the underlying assumption being that flows through directly into performance, which if you look at the performance of the fund from inception, we've actually generated 6.1% outperformance purely from that country and company sustainability overlay.
Greg, just on that note, so just looking at the fact sheet you provided us prior to the show, you've got Morocco, it looks like, as the biggest component or the biggest country allocation within Africa. That's obviously a function of the work that you do, understanding the sustainability practices of the country involved. Could you just inform us a little bit more around why Morocco is the biggest single country allocation in your fund, in this particular fund?
Yeah, well, it comes back to how we measure risk, which is firstly comes down to knowing what you're doing on the company. In other words, understanding the companies that you're investing in detail. And then the second component is the price that you pay for the security. So if you look at the Moroccan market year to date in US dollar terms, it's down 12%. Compare that, for example, to Egypt, up 31%, Nigeria up 30%, Kenya up 28%. So obviously, within this portfolio, we've got quite a disciplined rebalancing process where effectively the stocks that have run hard above the rest of the portfolio, we're taking profits on a regular basis, and then those that have underperformed relative to the portfolio, providing that the fundamentals of the company are still in place, we'd be increasing our position. So we tend to be buyers when the rest of the market are sellers, and vice versa, if you like, through this disciplined rebalancing process. So that partly explains, if you think of the net swing factor between Morocco and those other three key listed equity markets, just on a price basis, we've rebalanced during the year more into Morocco. Also, we've identified several high quality companies there, including commercial banks, utility company, and telecoms, where, you know, for example, Maroc Telecom, which is a company trading on a dividend yield of 8.5%. Very strong market position, dominant competitive advantages, high barriers to entry, excellent management team, and strong corporate governance. So for us, that's a company you're already getting an 8.5% return in US dollars just from your dividend yield. So, you know, if you get 10% capital gain, 10 to 15% capital gain during the year, you've got quite a low risk return of, say, 15 to 20% in US dollars, because more than a third of your return is coming purely from that dividend yield.
Greg, just listening to you and that list of things, the categories, and you by no means mentioned them all, you sound like a ratings agency, but one that is committed as opposed to involved. You know, the old story of the pig, you know, the pig is involved and committed in the bacon process. The chicken is only involved in the egg. But you must have developed proprietary technology here, proprietary research technology. You must have built up a valuable database to support your investment philosophy.
Yeah, and I think that's one of the unique aspects of Africa, and particularly investing in listed equities in Africa, is you can't spreadsheet it. No rating agency, or in the case of sustainability, no one can just send you that data. You know, we've been on the ground for 5 years doing that work to get to the point where we are now. So as you say, most of our investment decision making is led by first-hand proprietary data that we've really gathered, you know, on site by doing the hard yards on the ground. So it's true, and you're probably 10 to 20 years away from where, you know, you can sit down and get sent that data, or you can get all of the information you need from, let's say, the annual report, the notes to the financials. So there's definitely still an aspect in terms of the investment research where you need to get your hands dirty. You need to look into the whites of the chief executive officer's eyes and ask them difficult questions. You know, in their home country, you need to actually do your checks and balances and not leave any stone unturned, because although it's a much less sexy form of return, if you look at the performance attribution on the Africa Sustainability Fund, a lot of the good performance comes from avoiding major capital losses in poor quality companies which are trading at high valuations, where you participate and you lose 50, 60, 70% of your capital. That can be more important to your overall fund performance than necessarily finding a few big winners that increase by 10 or 20 times in value.